Go to chapter 17, interpretation of financial statements. So we're talking about financial statements, we're talking about the statement of financial position and the statement of comprehensive income. So it's required by law, and according to the international accounting standards, every public limited company must provide a financial statement for their financial year. So let's go forward now. This is the statement of comprehensive income. The statement of comprehensive income is used by most PLCs to show the income and expenditure of the business for a period of time. So for the statement of comprehensive income, this is a statement or a document that shows the income and the expenditure of a company. So what are the items we find in the statement of profit and loss? We have the revenue. For revenue, we're talking about the amount of money made from buying a product, from selling a product or selling the service to a customer. So that's revenue. Then we have the cost of sales. These are the amount of money spent to ensure that the product is made available. Then we have the gross profit. For the gross profit, it is your revenue minus your cost of sales. Then we have the selling expenses. For selling expenses, these are the expenses you incurred in the course of selling the product, which can be carried outward. Then we have the administrative expenses or admin expenses. These are general overheads or indirect costs of the business. For example, might include the salaries, the senior staff, stationery, accountancy fee, telephone bills. All these are indirect fees. They are not attached to the sales of the business. They are not attached to the sales of the business, but they are part of the cost incurred by the business. Then we have the operating profits. So how do we get our operating profits? The operating profit is gross profit minus your selling and administrative cost. So we have our operating profit here. That's the operating profit is your gross profit minus your selling and administrative cost. Your selling expenses, and you add your selling expenses and administrative costs together. That's about operating profit. Then we have the finance cost. For the finance cost, we're talking about finance cost. We have finance cost, we have finance income. For the finance cost, this is when the business borrows money, the interest you pay on the loans you take is called finance cost. Then the finance income, this is when a business has, you have a fixed deposit account and the bank has to pay you interest on them. That is our finance income. Then we have the profit for the year, which is the same as the net profit. Your profit for the year, your net profit, it's the total profit you have, your net profit minus your taxation will give you your profit for the year. So we have the profit before tax, and we have the profit after tax. For your profit before tax, that's the net profit for the year is operating profit minus your cost of finance. So the operating profit is this 3.5 here, and your finance cost is 0.4. So the difference between your operating profit and your finance cost is your profit for the year. That is the net profit. But the profit after tax is the net profit minus your taxation. As soon as you pay taxes, then you have your net profit. So these are the items in the statement of profit and loss. Then we have, so this is how the statement of profit or loss looks like. We have the revenue, the cost of sales, your cost of sales minus your revenue gives your gross profit. You had your selling expenses, and you take away your selling expenses and administrative expenses to have your operating profit. Then your operating profit minus your cost or your finance cost gives you the profit for the year. Then we go to stakeholders. Interest. Who are the stakeholders? We're talking about those that have interest in the business activity. So what interest do they have? What does the financial statement needs to do with them? So we start. For the shareholders, they said, obviously, the owners of the business are interested in its performance. Shareholders are likely to be interested in the profit made by the business, particularly the profit for the year. That's the net profit after tax. This is an effective guide to the performance of the business, but not the only guide. Rising profit suggests improving performance. It is possible for shareholders or their representatives to calculate profit for the year and gross profit margins using information from the statement of comprehensive income to assess performance more thoroughly. So what they are saying is this: for the shareholders, Why do they need the financial statement? They need the financial statement, especially the statement for profit and loss, because it gives a clear picture about the performance of the business. They can use it to determine the profit margins, the gross profit margin of the business. That also tells them what percentage of dividend they're going to get, because the more profit the business makes, the more dividend attached to the shareholders. So the shareholders need the statement of profit and loss because it allows them to know the performance of the business, and it gives them a clear picture of what their dividends is going to be like. For the managers and directors, why do they need, what relevance is it to them, the financial statement? For managers and directors, because they are the ones responsible for the key decisions of the business. They take charge of business activity. They make decisions. So whatever happens to the business, it becomes their own responsibility. So if the business is doing well, then it will reflect in their CV. If the business is not making profit, it means they are not doing well. So if the business is able to meet the target, it means the managers and the directors have done so well. And it can only be said that the managers and directors have done so well through the statement of profit and loss. For the employees, why is it relevant to them? Let's say if employees want a wage increase, to be able to have access to some of the information in the statement of comprehensive income when presenting a claim. So for employees, why do they need the statement of profit and loss? They need it whenever they want to claim increase in wages. This tells them that, employer, you have to increase our salary. The profit has increased over the years based on what we have seen. And the profit wouldn't have increased if we have not put effort into the job. So we need more payment. And if they have access to the statement of profit and loss, they'll be able to claim such claim. Then for the suppliers, why do they need the statement of your financial statement? Before a supplier could accept an order from a new customer on trade credit, it is sensible to check their credit worthiness. So the ability to pay for what they have bought on credit. So for suppliers, before they can sell to you on credit, they want to be sure that you are credit worthy. And for them to be sure that you are credit worthy, for them to know that you are credit worthy, they need to check your statement of financial. They need to check your profit for the year. So that will show them, that will give them a guide, that will give them a clear picture of who you are as a business and if you are credit worthy or not. For government, you have to pay taxes. So we said your profit for the year will be your operating profit minus your finance cost, minus your tax. So all these tax, before you pay, you have to pay taxes to government. So the tax authorities, they want to be sure that you have given them the right figure, that you have paid the right percentage of tax. So that is why government needs your financial statements. Do you have any question about that?
No.
All right. Then we go down to the statement of financial position.
Oh.
What?
Okay, go ahead.
All right. For statement of financial position, we're talking about the balance sheet of the firm, of the company. That's the assets, the liabilities, and the capital. So for the assets, these are the resources. These are the resources that the business owns and uses. Assets are usually divided into current assets and fixed assets. So whatever resources that the business owns and is using, we call it assets. For liabilities, liabilities are debts of the business. That is what the business is owing to other businesses. And we have the long-term and the short-term liabilities. And for capital, capital simply means the amount of money invested or introduced by the owner of the business to the business. So we have some calculations there, but before we go there, so how do we calculate asset? Asset is capital plus liabilities. Put that in your mind. Asset is capital plus liabilities. Then what are the key information or the items in the statement of financial position? We have the non-current assets. When we talk about non-current assets, we're talking about assets that are sold, that can last longer in the business. They can last more than a year. We call them non-current assets. So in the balance sheet, we have examples of them are the goodwill. Though goodwill is not physical, you cannot see goodwill. You understand? It's not physical. So what is the example? They said goodwill exists if a company has built up a good reputation. So when we talk about goodwill, we're talking about the reputation of the business. That's for goodwill, which is a non-current asset. It can last forever. There are other intangible assets like patents. Talking about the brand, the branding of the business. Then we have the physical assets like property, plant, equipment. These are tangible assets that the business owns. Then we have investments. So these are financial assets owned by the company. Example of investments are your shares. That's about that. So look at the statement of financial position here. We have the non-current assets, which are the goodwill, other intangible assets. Then we have tangible assets like the property. We have the current assets. These are assets that can only last within a year. We have the inventory, which are stocks. We have the trade and other receivables. We have the cash and cash equivalents. So the non-current assets plus your current assets gives you your total current assets. Then we have the current liabilities. And when we talk about liabilities, we're talking about for current liabilities, there are liabilities that can only be within a month, like borrowings, trade payables. So we take it one at a time. For borrowings, that means maybe you take a short-term loan from the bank, like a short-term loan like bank overdraft. Trade and other payables, these are your suppliers, your credit suppliers that you have to pay within a year. Dividends payable, you have to pay your shareholders. Current tax liabilities, you have to pay your taxes. For the non-current liabilities, these are long-term liabilities that can last for more than a year, like loans and borrowings for more than a year, like mortgage. The pension obligation can stay for more than a year. Other provisions for expenditure, like provision for other liabilities, they can stay for more than a year. Then how do you get your net assets? For your net assets, it is the value of your assets minus the value of your liabilities. That's our net assets. Then we have equity. When you talk about equity, we're talking about the capital. So how does a business come up with equity? We have the share capital. This is the amount of money paid by shareholders. Then we have the share premium account. This shows the difference between the value of new shares issued by the company and their nominal value. So for the share premium, the value of the share is there. That's the value of the share. And the nominal value, the value of the share right now. Okay, let's say the value of the share is 1.5. The nominal value is 2. So the difference between the nominal value and the real value gives us our share premium account. Then other reserves. These are amounts of money owing to the shareholders not covered by the other entries or other equity. For your reserves, this amount of money you are supposed to pay to the shareholders, but you are not paying right now. You are keeping it for a later time. Then retained earnings. For retained earnings, we're talking about the profits you made by the business. So you keep the retained earnings. So how do you prepare these accounts? This is how they prepare the account here. So this is the financial statement on the right side here. You have your non-current assets, intangible assets, the property. These are the items that have to be there. For your current assets, you have the inventory, the trade payables, the cash equivalents. Then your total assets will be your current assets plus your non-current assets. Then we'll go to the liabilities. What you have to take note is that for your liabilities, we're talking about your current liabilities, we're talking about the non-current liabilities, which are, for your current liabilities, we're talking about trade payables and other payables, your current tax liabilities. For your non-current liabilities, we're talking about borrowings like loans, the pensions you have to pay to those that have retired, gives you your total liability. Then your net asset will be your total liability minus your total assets. Your total assets minus your total liabilities gives you your net assets, which is 29,799 minus 11,464 will give you your net assets. So your net assets must be equal to your total equity. So that's how it is being calculated. Let me see what we have again. We've talked about the stakeholders' interest, the suppliers, the money. Okay, here now we talk about, let's see, We've talked about the suppliers and managers and directors. We've talked about them. They prepare the balance sheets. Okay, let's see. I think we have, hold on please, let me see. Yeah, for the statement of financial position, first we've talked about the statement of profit and loss and stakeholders' interest in the statement of profit and loss. So what are the stakeholders' interest in the statement of financial position? So for the statement of financial position, what are the interests of stakeholders? Number one, for the shareholders might use the balance sheet to analyze the asset structure of the business. For the shareholders, why do they need the statement of financial position? They want to analyze the assets they have. They want to understand how solvent the business is. Does the business have liquid assets, or is the business having more liabilities than the assets? That is why the shareholders would want to know more about the financial statement or the statement of financial position. Then for the managers and directors, like they are the decision makers. So why do they need, what interest is it to them, the statement of financial position? The balance sheet might be used by the management of a business, for example, for the senior managers to be aware of their firm's financial position at all times. So they want to know their financial position. Are they owing more businesses, or they are owing less? What do they have in terms of cash? What do they have in terms of assets? What do they have in terms of liabilities that they have to pay? So the managers, they want to know how stable the business is. That's why they need the statement of financial position. For the suppliers would not want to supply to you as a business when they know that you have a lot of credit customers that you have not paid. Because in your statement of financial position, there's an item for trade payables. So if your trade payables are much, then suppliers will not be willing to supply you more, because they feel that you are owing a lot of creditors and they don't want to be part of those creditors you are owing. So that's why they need it. For others, like employees, for employees, they might use the balance sheet to assess whether a business can afford to pay, to increase their pay or not. How do they get to know this? They get to know through the assets the business is having. And if the business is having less liabilities, it means that the business is in a very stable financial position. That means it can increase their salary. For governments, they want to gather information. They want to be sure that the information you've given is right, and they can use the information about the statement of financial position for national statistics. They can use it as a reference point for other businesses. So that's all about statement of financial position. For the financial statement, we have two things about financial statements. Like I told you, we have statement of financial position, and we have statement of profit and loss. And for the statement of profit and loss, it only applies to the income and the expenditure of the business. For statement of financial position, it only applies to the assets, liabilities, and capital of the business. Do you have any question about it?
No, it's all clear, sir.
All right. So that's about chapter 17.